banking stocks are in the news lately. There's been a lot of talk about some of the banking stocks recently. So what better time to do a deep dive into their performance? And joining us tonight to give his analysis on banking stocks is founder of Wealth Watch JA, Julian Morrison. Welcome back to the show, Julian.
Hi, Kalila. Hi, everyone.
Great to have you. All right. So what banks are we looking at tonight and how have they been performing over the past year?
Okay, so I have a sample and I'm looking at NCB, JMMB, Scotia, and Sagicor. I'm going to share my screen just to make life easier for everyone. Can you see?
Yes.
I'm going to zoom in.
I was just about to ask you to.
We've been through this enough times.
Right.
Yeah. So now we're live. So what's the significance of looking at all these ratios?
You can
Now,
zoom in more, you have more space.
sure. I'll
Yeah,
just put them all in bold to make life easier too.
NCB, JMMB, Scotia, and Sagicor.
Yeah. So what's the importance of looking at all of these ratios? At the top, we look primarily at how these banks are managing their capital. And capital is very important to banks because just the way raw material is important to distributors or goods manufacturers, capital is a raw material for large banking conglomerates. So the key is to understand how that raw material is being managed. Now, what we try to look at as a proxy is the equity to asset ratio. How much of the asset base is made up of equity? And this is equity attributable to shareholders. And what we try to analyze is for each dollar of assets, how much of that is made up of equity? Because assets are made up of equity and liabilities. I hope everyone remembers that from accounting class. But how assets are funded is critical to understanding the financial health of an institution. Now, there has been a lot of talk about NCB and NCB turnaround and the bull case for NCB. But before that conversation can be framed, one, we have to compare all institutions or all opportunities to comparable opportunities, number one. And number two, we can't look at price in a vacuum. We have to ascertain if we're getting value or not. So the key to understand this is to know that for every dollar of assets, there's 7 cents or roughly 8 cents of equity being funded. Or it's funded by 8 cents of equity. So every dollar of assets, 8 cents is being funded by equity. And that's similar for JMMB. So they have a similar risk profile as it relates to the funding mix. But as it relates to Scotia, for every dollar of assets, $20 is funded, 20 cents, sorry, is funded by equity. And for the case of Sagicor, for every dollar of assets, 16 cents or roughly 17 cents is funded by equity. So what we begin to understand is that the risk profile in terms of the funding mix is totally different. And just for the purposes of transparency, I don't hold any of these stocks. I'm actually taking a step back from banking stocks right now. I have for a few years now, I have recommended opportunities outside of the sector. But for those who want to take a look or who already have those holdings, I wanted to give somewhat of a comparative analysis. The equity to assets, the assets to equity, sorry, in the following line is the same thing, but it is inverted. So it's looking at it from another perspective. So you're looking at it from the standpoint of a multiple. So how much greater is asset relative to equity? And in this case, for NCB, it is 12.58. So assets are 12.58 greater than equity. And For JMMB, it is 13 times. For Scotia, it is 4.9 times, and for Sagicor, it's roughly 6 times. And just to go back to equity to assets for a bit, typically the benchmark for this ratio is 10%. You don't want to go below 10%. So if you find that less than 10 cents of your assets are funded by each dollar, sorry, if you find that the ratio is off by less than 10%, it means that your funding mix is out of whack and it needs to be corrected as soon as possible.
So that's for the second one, that's for assets to equity?
That's for, no, equity to assets.
For the first one?
Yeah, you don't want to go below 10%.
Okay.
They call it the tier one. They call it the tier one ratio.
Okay. So we're looking at NCB and JMMB having ratios below what is ideal.
Correct. It can happen for short periods of time because of circumstances that may not be ideal. So it's very important to track these things over multiple financial years. But if you have 3 successive financial years where tier one capital is less than 10%, then it means that you have a serious issue. It means that you need to raise equity very soon to balance it back out, which is why we would have seen NCB attempting an APO last year. This would have given us some perspective around why that equity raise was attempted, because it's a matter of balancing the asset mix. You don't want to have too much of your assets funded by liabilities. So you don't want to have each dollar of assets funded by less than 10 cents. But in the case of NCB and JMMB, that is the case. So
these numbers here are for what period of time?
These are for the respective periods that are the latest on the Jamaica Stock Exchange.
So for instance, 1 year?
All the numbers are annualized. So yes, they do reflect the performance of a year, but all of these are the latest figures. So for example, JMMB's latest would have been their audited for March. The period ended March 2025. For NCB, it would have been the period ended June, etc., etc. I think Scotia was April and Sagicor was also June. So these are the latest numbers that are up. So all these ratios are based on the latest data that's on the Jamaica Stock Exchange right now. The next area we want to look at is the loan to deposit ratio. How much of the deposit base is actually deployed in loans, because again, deposits are the raw material for deploying loans, and loans generate interest income, or what is more important, net interest income for these institutions. Major line item for performance. And as we notice, Scotia, their loan to deposit ratio is 63.4%, and Sagicor is 48.9%, and NCB is 77.6%, while JMMB is roughly 96%. So it means that it shows you how much more can be deployed by these institutions in terms of lending, and it also gives you an idea of how aggressive the lending policies have been. I'll just say that the numbers speak for themselves. So it's not enough to just look at the price of these companies, but
so is it ideal to have the higher the number, the better?
The higher the number is, the higher the level of aggression. So it means that the deposits are being put to productive use. If it is at 75%, it means that the bank is at a point where they don't need to be concerned. They are pretty much being productive with the deposit base, with the deposits that they have on hand. But if it's a case where it's above 90%, then it means that they need to probably relax their lending policy. Well, not relax it, become more conservative with their lending, or look to buttress their deposit base relative to the loans that are out there. Because pretty much, if it was a bakery, you'd be running out of flour. So the deposits is the flour and the bread is the loan. You need deposits to generate loans, and you need to be able to manage your raw material, which is the deposit. So the key is to understand how much risk the institution is taking and how much more capital, which is raw material, they have to actually enable further growth. So this also shows the growth capacity of the institution. How much more can they grow? And as you notice, Scotia has a lot further to go, and their capital base is healthier based on their funding mix. They can afford to take on more debt. They can afford to be more aggressive if they need to. And if you remember, about 3 years ago, during the pandemic, when the other institutions, some of the other institutions, were focused more on just generating higher margins and greater profitability, Scotia sacrificed that to focus on their capital base, and now they are benefiting from that sacrifice.
But for
So,
Sagicor, why is it so low though?
well, to be honest, Sagicor isn't as dominated by its banking assets as the others. The dominant asset in their asset mix is actually the insurance company. So that is why we would have seen a difference, because the crown jewel in Sagicor is the insurance company, while the crown jewel for Scotia and NCB is more so the bank for those respective companies. So a lot of it has to do with the structure of the company and what generates most of the economic value from that standpoint. But they are a major contender, which is why I included them in the exercise. Um, so NIM here is a net interest margin, and it's basically the net interest income divided by all the assets that generate interest on the balance sheet. And the net interest income is pretty much telling you what spread the the institution is getting from its assets. So banks have to borrow, and they have to unlend that money. So they borrow at a certain rate and they lend at a certain rate to get a profit. And the difference between the rate at which they borrow and the rate at which they lend is called a spread. And that spread has to be contextualized not just by the two rates, but how much is that profit relative to all of the assets on their balance sheet that can generate interest. So what is the yield? What is the yield from all the assets that they're generating? So right now, NTB has the highest net interest margin. That's not surprising because they have always been more aggressive in terms of generating yield. Um, right now, NTB is at 3.64, JMMB is at 2.1, and Scotia is at 2.25. So I think in terms of risk relative to generating a risk adjusted return, I think Scotia is in the best position because they have an asset mix that is superior to NCB, but their net interest margin is not that much lower than NCB. So they've managed to have the best of both worlds. So these are some things that we can use to compare financial institutions. How much risk are they taking and how much of the spread are they taking while they're taking that risk? Another area to focus on is the operating efficiency ratio, which is the total operating expenses divided by revenue. Um, right now, the company that is doing the best, I mean, the lower the number is the better it is. So Scotia is doing the best, while JMMB is doing the worst in terms of efficiency. I remember back in the day when Patrick Hilton was running NTB, that was his favorite word: efficiency, efficiency, efficiency. So the key is to ensure that efficiency is as low as possible, because it's basically your cost to income ratio. So how much of your revenue is actually making it to the bottom line? That is what this ratio is looking at. And finally, the number that everyone loves, net profit margin. So net profit margin is the highest for Sagicor right now, followed by Scotia, then NCB, then JMMB. But what we need to remember about NCB's latest figure is that they got a one-off $15 billion gain from the sale of a subsidiary. If that $15 billion was actually removed, and we'd have a more of an adjusted result or a normalized result because it's a one-off. You're not going to sell a subsidiary every day, which is why we say it's a one-off. We would have gotten a materially different result. The net profit margin would have been in the single-digit territory. So again, We can't look at one-off results as a explanation for a turnaround to say, okay, an institution is out of the woods. Um, is it that we don't have to worry anymore? Or do they have more work to do? Um, it's good that they generated more profit, but how profit is generated is actually very important. And with this asset mix, selling a subsidiary for $15 billion isn't enough to turn around their situation, as you can tell, because you're supposed to be at 10% or higher. Now, in terms of the valuation, it begs the question now, is the valuation justification for where it is from a risk standpoint? So,
Mm.
is a PE of 5 low enough for the level of risk that we're seeing coming from NCB, for argument's sake? Meanwhile, Scotia, their PE is below 8, but you're getting a capital base that's superior. And what's the important thing about having a
So
superior capital base?
let's
Sorry, Tadia.
backtrack a little bit. Backtrack a little bit on Julian. So for the newbies in the house who don't know what PE is, let's
Okay,
just go over that a little bit.
right. So these two at the end, they track the price relative to the earnings, meaning the net profit after tax per share. So pretty much you want to pay you want to pay as little as you can for something that is as valuable as it can be in the relative circumstances. So what do I mean? You want to look for bargains. So typically speaking, lower PEs mean that you're getting a bargain, all else being equal. No, it's not a given. You can buy something for a low PE and the price doesn't move for whatever reason. We call that a value trap. So you buy something that's cheap and you get no upside, you get no profit on it. So it's important to not only buy cheap, but to buy cheap in assets that actually have upside. They actually have promise. They have what is called a catalyst. There's a driver behind it, there's an engine behind it to produce the returns. And as you can see, based on the net profit margin, Scotia has the second highest net profit margin. They have the second lowest PE and they have the strongest capital base. So it means that the balance between valuation, the quality of the assets in terms of how it's funded, and their track record so far, they're in the best standing. So it's not enough to just look at the price and say, hey, this price went up X% in 2 weeks. But how is an asset performing relative to its peers? How much risk are they taking? What's the health of that company in terms of its balance sheet? And also, what price am I paying for that same company? The next one is price to book. So the book value is just the net worth of the company. So you're looking at it strictly from a balance sheet standpoint. The book value is shareholders' equity or the net worth, so assets minus liability. And the book value per share is the equity per share or the net worth per share. And the net worth per share is not always the price per share. So some industries are friendlier to book value than others. Book value is very popular in assessing financial institutions because, again, it's capital intensive. A lot of what makes banks work is carried on their balance sheet. So we use book value as an assessment in analyzing valuation for these kind of stocks. So pretty much you shouldn't really be paying more than 2 times book value for a financial institution like these. And they're all below 2. So is it that they're all worth buying? That's a philosophical question. So we need to look deeper. Not only is it less than 2, but is it less than 2 and is it generating an attractive return on equity? Is the net profit margin attractive? Are they managing their expenses well? And are they funded in a way that can generate sustainable dividends? Because what the equity to assets ratio tells us is their dividend capacity. If your equity to assets ratio is too low, it means that you're going to struggle to pay dividends because too much of your cash resources are going to be gobbled up by liabilities. That's why we also look at the equity to assets ratio. So when we see equity to assets in the double digit territory, what it means is that the company can comfortably pay dividends in a way that is sustainable. They're not going to pay the dividend as a one shot, but they can maintain what is called a dividend program. So if it is that the dividends are usually quarterly, they can satisfy the quarterly payment in a way that is stable, predictable, without having to make a release to say, oh, we're going to have to skip the dividend this time around, whatever the case may be. So that's why we're so concerned about the quality of the balance sheet and the capital and how the asset base is funded, because it ties back into something we love so much as investors, which is dividends. So everyone knows that Scotia has been on my watch list. I hope tonight the reason for that is made clearer. I have a bias for that reason. Currently, I don't hold it, but I think it's a superior choice on the list. But if an investor believes that NCB is a buy at half its book value, I won't fight that thesis. That's a perspective, but it just doesn't float my boat. I don't think so, because again, having an equity to assets below 10% for multiple financial years and trying to raise capital all over the place, that doesn't speak that doesn't speak to me from an opportunity standpoint, meaning that it's very likely that there could be trouble down the road if there's an external shock. What if the US economy has a shock and it pulls down Jamaica and we go back into a recession? Because most of 2024 was a recession. We had 3 consecutive quarters of contraction. And even right now, NCB is having a significant increase in credit impairment losses, which means that there are more persons defaulting on their loans um, that are held within NCB, which is also a risk factor. Those things affect your dividend capacity because you need a cushion to absorb those credit impairment losses. I know this is a very technical conversation,
It,
so
it
I think,
is, but so,
yeah, I
and the
know,
viewers still have a lot of questions for
yeah,
you.
banks are
But
complex,
before
but
we get to the questions,
yeah.
give me the summary version. So if you were to rank these four institutions 1 to 4, 1 being the best, how would you rank them?
Actually, three would be NCB, and I'd
Mm.
put JMMB last. Just based on the basis of the valuation relative to the quality of their their capital or their balance sheet, I think that this is a proper ranking.
So
And it's
Scotia
subjective.
first, Sagicor second, NCB third, JMMB fourth.
Yeah, yeah. And this is subjective. This is subjective, not a knock to any institution. Um, I am a fan of JMMB for different reasons. I am a JMMB customer. Let me just put all of that out there because I don't want anybody to call me or message me. Um, I have nothing against JMMB. I'm just looking at the numbers, and if I had to ration my capital as an investor and I had to spread my capital across the sector, this is how I would do it. It
And
would be
notice
in
I
this
didn't say
order of
first to
precedence.
last. I didn't say first to last because there's some other financial institutions that weren't included.
Yeah, definitely,
You
definitely.
have First Global Bank, you have CIBC, for
Yeah.
example. All right,
Mm-hmm.
so let me take some of the questions.
Yeah.
D wants to know, is it that they could deploy more, or is it they aren't getting enough viable candidates for the loan products?
It can be a mix of both because of a competitive market, but it has a lot more to do with the former than the latter because there are so many loan applications that are refused. Even within the context of business loans, there's so much business that's turned away in the underwriting process. Um, Jamaica is still a society that's fairly unbanked. Our financial inclusion is below our developed country counterparts. So I would argue that it is more the former than the latter. But competition is a factor for sure.
Nigel wants to know, does NCBFG's ownership of Guardian Holdings make any difference?
Definitely. Um, Guardian is a major aspect of why their net profit margin is not worse. Let's put it that way, not worse. and why the efficiency ratio is not worse. It's actually it's becoming NTB's crown jewel. So every company or every group of companies, especially conglomerates, they have what is called a crown jewel. It has that asset that is their center of gravity. It's their star player. It's what drives the performance. And in recent years, it has become more and more leaning towards Guardian. So yes, Guardian does make a big difference. But there are some other subsidiaries that seem to be undercapitalized, and the undercapitalization of those subsidiaries biases the undercapitalization of the group. So if I have big assets that are undercapitalized, it means that the overall group is going to be starved of cash because you're going to have to channel so much more of your cash resources towards those big assets that are not doing so well, despite Guardian's performance. So, yeah,
Roswell has an observation. She says JMMB is banking on Sagicor's earnings with their 23% stake in the company, but cross investment doesn't always benefit profits if the other company doesn't do well.
definitely. I think the investment in Sagicor parent was the timing of it was unfortunate, definitely. Even but from a risk standpoint, you see, because it's carried at market value, every time Sagicor parents stock price drops, it also affects them because they carry it at market value. Um, so it's not just a profit, it's not just a profit contribution, but also the performance of that respective stock price. Because of that, you have a double-headed dragon, and it's very risky. The size of the investment is huge. So if the size of the investment was smaller, it would have been bad and not so bad. But based on the size of it and the double-headed dragon that I mentioned, which is the stock price and the actual profit, it's kind of tricky.
Last question I'm going to take is from Philip. Doesn't the money gained from the sale of the subsidiary remain on the balance sheet?
Yes, yes, it does. But remember that NCB is about to pay a dividend, and some of it would have come from the sale. Um, oh, I get what he means because it's being sold from one NCB related entity to another. So you're asking if that gain is real or not from a cash standpoint. Um, I haven't interrogated that enough, but from my understanding and from what I know and from what I've seen, it wouldn't be reflected totally in cash because it's just moving from one part of the group to the other. So you haven't created new value. It's really just moving the 15 billion from one area to another.
All right, so we're going to leave this conversation here for now.